The government of Canada also, of course, gets involved with the RDSP in trying to assist families that are trying to save money for their disabled child. Okay, so government of Canada gets involved, and what they have is what they call the Canada Disability Savings Grant. As it says, it's a grant, so say basically it's a freebie. I won't get into the math of it; it's not important because it changes all the time. Basically, Canada's Disability Savings Grant. Is paid by the government of Canada, paid to the age of 49. In other words, at age 49 will be the last payment. So we usually recommend that you start the RDSP quite early in life, so that way, like as soon as possible, basically, you know. So if your child is disabled right from birth, you may want to start one almost right away, basically. But if that child becomes disabled later on in life and everything else, you may want to start this as soon as possible, because the savings grant actually stops at age 49, so you may want to start earlier. So make sure that you get that those freebies, so to speak, from the government of Canada. Okay. So the payments, the money that comes out of an RDSP, can only be made to two areas. It can only be made to the beneficiary, whoever that plan is for, and everything else. Okay, or the legal representative, and that legal representative could be, the trustee, could be the guardian, whomever. Always be careful who you pick as legal representative, just to make sure that they don't take advantage of their privileges and everything else. So there are, situations like that can happen. But basically, the money can only be paid out to the beneficiary or whoever is representing that child as your legal representative. Okay. And there are essentially two types, you might say, of payments that a client could get. The Disability Assistance Plan, in other words, what they call a DAP. So basically, it will pay you a certain amount of money over a limited period of time, whatever that happens to be. Okay, so Disability Assistance Plan. You could buy a single payment. We don't recommend that. That's obviously not a continuous payment. It's one lump sum. Certainly we don't recommend that at all. So I would sort of discount that altogether. Okay, and you can also buy a lifetime annuity. Okay, a lifetime annuity, and that's they call an LDAP. Okay, a lifetime disability assistance plan. So this is for a limited period of time. This, of course, is for forever and a day. Basically, what they call an LDAP. Okay, regardless of which one you pick. The income must start no later than age 60. So this is not an age 71 thing or whatever. This is basically saying at age 59 was the last contribution that you can make, and income must start at age 60. So you have to start taking money out basically at age 60, and then for the rest of the person's lifetime or whatever the case may be. Draw your attention to this, very important. The earnings are taxed. Remember that when you made the deduction, when you made the contribution to the RDSP, that was already after-tax dollars because you never deducted that, okay? And so now the money in the RDSP has grown on a tax-free basis, on a tax-sheltered basis and everything. So when the money comes out of the other end, the principal, the money you paid, so let's say you did put in the entire $200,000 through all that period of time, you put in the entire $200,000. And that 200,000 grew to 300,000, let's say, because of the earnings and everything else. When you start taking money out, monthly, quarterly, however it is that you decide to take money out, the principal portion is a return of your own money. In other words, the principal portion is your ACB. That will not be taxed. But the 100,000, okay, the earnings on that will be taxed. So unlike an RRSP, where because you took a deduction, you have a fully taxed product because the ACB is zero on registered money, okay? In this case here, you didn't take a deduction. All you did was you put the money in, you got all that wonderful tax sheltering and everything else, so that was fine. But now when you take the money out of the other end, the principal, the amount of money that you actually have you've actually contributed, that can be taken out tax-free. That's not a problem, okay? But the earnings, okay, will be taxed. So in the example I just used for $200,000, let's say you put in, and now you have it's actually worth $300,000. That $100,000, that is earnings, and you will have to pay tax on that as interest income. It's not capital gain or dividends. It is interest income, so you will have to pay tax on that, okay? But on the principal, on the $200,000, if you're taking that out, that money will be, in fact, tax-free. And, of course, we'll see you next time.